Hello YouTube, Mike the CPA here. Welcome back to Money in Life TV. Thank you for joining me. I am so excited to see you guys today because I have some great information to share with you. This has been a long time coming and I've gotten a request after request after request to make this video. Well, finally, it's here.
Oh my god, oh my god, oh my god!
In today's video, we're covering the 2018 tax updates for business owners from the Tax Cuts and Jobs Act. I've pulled together what I consider to be some of the biggest changes from the Tax Cuts and Jobs Act and put it in the spreadsheet for you guys. And the spreadsheet, as you know, just like the one I made in my individual tax update video, is completely free for you to download. So just go to the description section below this video. You're gonna find a link, click the link, and then in the top right corner, there's a little button. If you click that button, you can download it for free for yourself, and you'll have this information so you don't forget what we're gonna talk about. Now, I'm gonna try to go over this information as quickly as possible with you guys. I'm gonna try to cut out a lot of the BS and just get straight to the point. Now, if you guys have questions, which I'm sure you're gonna have questions, because I'm gonna go over this information pretty quickly or as quickly as possible, leave those questions in the comment section down below. I'll be happy to get back to you as soon as possible if I can answer your question. And if just leave a comment in general. I love reading your guys' comments and I love hearing from you guys. Let me know what you think of all these new business tax law updates. Do you like them? Do you not like them? I would love to know what you guys think. If you like the video, let me know by hitting that like button down below. It means a lot to me when you hit that like button. And of course, welcome to anybody who's brand new here today, especially if you're checking out the channel for the first time. This channel is all about helping people become fiscally fit because we teach finances, investing, and taxes. All right, let's get it. First thing I want to point out, guys, is that some of these tax revisions may change. The IRS has not released guidance on a lot of the stuff we're going to discuss today, so just keep that in mind. Before acting on any of the information you see in the spreadsheet, realize this is not legal or tax advice. The rules might have changed by then based upon when the IRS releases their guidance, but I really think this video and this spreadsheet is going to give you a great overview of many of the changes of the Tax Cuts and Jobs Act. The first thing I want to point out is the business filing due dates. These have changed. Some of you realize this, some of you may have not. The due dates for partnerships, LLCs, and single member LLCs that are owned by partnerships, the due date is now March 15th. The same goes with S corporations. C corporations used to be due on March 15th, now they're due on April 17th. Each entity type can get a 6-month extension, so partnerships, LLCs, etc. can be extended for 6 months until 9/17. S corporations the same way, and C corporations can be extended 6 months to October of 2018. If you have a corporation or a business entity that has a non-calendar year end, then follow these rules of how many months after the year end of when your tax return filing is due. One of the biggest changes is to the corporate tax rates. In 2017, the corporate tax rates were on the graduated scale, so as your income went up of your corporation, so would your tax rate. But now in 2018, it is now a 21% flat tax across the board. So you don't get the lowest rate, but you don't get the highest. So overall, corporations are saving quite a bit under these new rules. This is set to remain permanent. If you remember, many of the individual tax laws were set to expire after about 5 to 10 years. Well, these business laws are set to remain permanent. Note, for non-calendar year-end companies, expect to use a blended rate of tax using a weighted average method calculation. Okay, let's look at the example of the weighted average method. Think of a corporation with a fiscal year ending of June 30th. In this example, the tax rate from July 1st of 2017 through December 31st of 2017 would be 34% roughly, right? Well, then we have to take into account from January 1st through June 30th of 2018, it would use the new tax rate of 21%. And so you're kind of using a weighted average to figure out your taxable income in that instance. Couple of depreciation updates real quick, guys, and there's a lot of them, but I've just kind of condensed some of the main ones down. And remember, there's links to all of this stuff down below that will lead you to a lot more information, but you're going to see that at the end of the spreadsheet here. Okay, guys, here's some quick depreciation updates, which I think you should know about. In 2017, for bonus depreciation, we got 50% of qualified property, so we could deduct 50% of that property right away. In 2018, it's even better. So in 2018, now we can deduct anywhere from 50 to 100% bonus depreciation in the first year on qualified property. And just so you guys know, those new bonus rules went into effect as of 9/28 of 2017. So it started in September of 2017. It's going to carry forward from there. And I don't know if there might be some rule changes on this starting in 2020, 2021, but we'll have to wait and see. Section 179. In 2017, we can expense up to $510,000 of eligible assets that can take 179. In 2018, it's even better. We can take up to a $1 million Section 179 deduction. A couple things to point out here on the side so you guys can see this. Section 179 cannot drive your income below zero, but bonus can. Section 179 asset threshold in 2018 is now $2.5 million. Just so you guys know, it used to be around $2 million. Depreciation updates for autos. In 2018, the maximum depreciation we could take in the first year without using bonus was $3,160. Fast forward to 2018, in the first year without even using bonus, we can deduct up to $10,000 through depreciation on that vehicle. Awesome. Now let's look at it with bonus. So in 2017, with taking bonus, you could deduct up to $11,160. And the same looks to be true for 2018. You can deduct up to $11,160 and with bonus depreciation in the first year. Remember, guys, the deduction is limited if the vehicle is not for 100% business use. These rules apply up until January 1st of 2020, and then we'll see what happens from there. Standard mileage rates. I've listed this all out for you guys. You guys can go ahead and read this for the business mileage, charitable mileage, medical, moving. Not much has changed really. It's like a penny here, penny there, not a big deal. One of the biggest changes, guys, is the rules around meals and entertainment and fringe benefits. So let's look at that right now. Entertainment in 2017 used to be 50% deductible. Now in 2018, it is no longer deductible. Entertainment for a client, so you take a client out to a movie, out to dinner or whatever, was 50% deductible. Now it's no longer deductible. Employer operated eating facilities. So let's say you're a big business and you have, let's say, a Subway within your, or like a huge cafeteria or something within your establishment. So the eating facilities in 2017 used to be 100% deductible, but now in 2018, they're only 50% deductible. Transportation fringe benefits used to be fully deductible. So this is really for employees. So like the company would pay for their employees' transportation cost and they could fully deduct them. Well, starting in 2018, this is a kind of a bad thing for employees. It's no longer deductible for the employer. So the employer can still give the benefit, but now it's going to be included as taxable wages on that employee's W-2 if they're getting paid or compensated for transportation costs. Meals for convenience of the employer. So this is when an employer brings in meals to their office so that employees don't have to go out and about. They can eat their meal right there and keep working. So in 2017, it was 100% deductible. 2018, going forward, it's only 50% deductible. Okay, now let's talk about meals in general. And this includes meals for travel. In 2017, it was 50% deductible. Meals are still 50% deductible in 2018. So those haven't really changed. What about office holiday parties? 2017, fully deductible, 100% deductible. 2018, it is still 100% deductible. But what about other things like employee gifts and awards? So in 2017, cash, gift cards, tickets, etc., it was up to $400 per award, up to $1,600 per year per employee. Now, the rules have changed for 2018. So now it can no longer be cash gifts, gift cards, and things like that. Now the gift must be tangible personal property. No cash, no certificates, gift cards, tickets, etc. So that really bites for employees when they could have got cash or a better gift. But the rules have changed on that. Okay, real quick, guys. Under entertainment, just some examples. If you're like, what is entertainment? It's things like sporting events, activities, clubs, things like that. For employer-operated eating facilities, as we discussed, it's going to be no longer deductible after 2025. Last thing I want to mention on this, guys, is meals for convenience of the employer. It's supposed to be no longer deductible after 2025, so just keep that in mind. The last thing I want to say, guys, regards to meals, entertainment, and things like that, for accounting purposes, I recommend tracking entertainment and meal expenses separately for accounting purposes. Break that information out for your CPA, for your accountant. It will save them a lot of time and save you guys money on your books if you use a CPA or an accounting professional to help you keep your books up to date. Okay, now with excessive business losses, IRC section 461. This really applies to pass-through entities. So in 2018, there's going to be limits on how much of a loss you can deduct. For 2018, for a single individual, it's $250,000. For a married couple, it's $500,000 is the excessive business loss limitation. A couple of things to note on that. Aggregate tax loss from all trades or business is included in that calculation. And excess losses, if you can't use them, the good news is that they will carry forward. And there's no NOL carry back, which we're going to talk about right now. But those excessive business losses can carry forward to a future year. Basically, what used to happen, guys, is let's say a person had a really successful business. Well, then they would go open up a restaurant, dump millions of dollars into this restaurant, and try to deduct the full thing. And use it as like a huge expense offset for tax purposes. Well, the IRS is hammering down, and they're no longer going to allow that. Okay, guys, a lot of updates on net operating losses. In 2017, you could carry back the loss 2 years or carry forward the loss for 20 years. In 2018, the carryback provision is now repealed, so you can no longer carry a loss back to previous years where you had income. You can only carry it forward. Also in 2018, note that the net operating loss is limited to 80% of taxable income. Other things to mention, pre-2018 NOLs must be used up first. NOLs can only be carried forward starting in 2018. But remember, guys, the good news is these NOLs can be carried forward indefinitely. So those are some of the changes going on with net operating losses. My advice to you guys is if you have net operating losses that you want to carry them back, do them now before you can no longer do it. Business interest deductions limitations. This area was huge. A lot of things going on here, guys. So now there's the new limits cap, basically 30% cap on interest deductions. So the rules state before 2022, the cap limit follows 30% of earnings before interest, taxes, depreciation adjustments. After 2022, it follows earnings before interest and taxes. It's important to know that net operating losses will affect this calculation. In regards to the carryover period on this, guys, if you can't deduct the interest in that year, there's an unlimited carryover of disallowed interest, so just keep that in mind. There are exceptions to the interest cap rules. That is when interest is used to offset business interest income, or when electing real property business, or for regulated utilities are some examples of when the exception applies. Also remember, gross receipts less than $25 million, average in less than 3 years. You would not have to follow these new rules. You would not be limited. So as long as your gross receipts are under $25 million, you would not be subject to these interest deduction limitations. Okay, guys, business research expenses. There's a lot of debate going on in this one. So rules before 2021. Expenses are allowed to be deducted when paid or incurred or can be elected to capitalize and amortize. This should not affect their R&D credit. Now, rules starting after 2021. Expenses must be capitalized and amortized over 5 years. 15 years if outside of U.S. It's supposed to have no effect on the R&D credit, but we'll wait and see what happens with that. So after 2021, basically with research expenses, you have to capitalize them over at least 5 years. Like-kind exchanges. Oh, guys, this is some big changes here. Exchanges other than for real property have been eliminated. So personal property. So what I see a lot is people will trade in, especially in a business environment, people will trade in their trucks or other business vehicles or machinery equipment. Well, you can no longer do a trade-in on those items and defer the tax on those. You're going to have to pay tax at that point in time when the item is disposed of. So really what they're saying here is the only items that really qualify for a true tax-deferred exchange at this point is real estate. So buildings and land and other real property. Like I said, I put it right here that vehicles are not considered real property. I think this is going to upset a lot of people. Some assets involved in real estate exchanges might actually be taxable during the exchange. So if you think of a home, like let's say, or a building, there's other things involved in that building. There might be fridges, stoves, other units of that kind of sort that is not considered real property. So when you're doing a like-kind exchange, remember you might have to pay taxes on those other items. You won't pay. You'll be able to defer the tax on the building and the land, but not the other items that are in the building. Last but not least, guys, the 199A deduction. And just so you guys know, I've listed some of the key facts here about this deduction. And we don't even know all the rules on this yet. The IRS has virtually released no guidance on these new rules. So we're going to have to wait to see what happens. But this is what we know so far. So I'm not going to do a full calculation here, guys. This is by far the most complex tax change in years. And some people say it's more complicated than the tax reforms that occurred back in 1986. If I tried to explain the calculation to you guys, I would probably lose you. There's a lot of uncertainties about this still, so we're just going to have to wait and see. If you guys would like, as I learn more information, I can eventually do a video on it, but let me know. So this is for the entities that are eligible for this 199A deduction include partnerships, S corporations, sole proprietorships, and ag cooperatives. Eligible taxpayers, individuals, trusts, estates. Key facts regarding 199A. It's 20% deduction on qualified business income. And there's a lot of debate on what actually is defined by qualified business income. Some people wonder if real estate income is business income. It's still up in the air. The IRS has not released any guidance on this. It cannot generate an NOL, so that's important to remember. And there's no deduction or offset allowed against self-employment tax. All right, let's look at the income limitations on 199A. So if your filing status is single, you'll get the full 20% deduction if your taxable income, now listen to what I'm saying here, taxable income, not total income, but taxable income is less than $157,500. If your income is above $207,500, it is likely you'll receive no benefit at all from 199A. If you're married filing joint, if your taxable income is less than $315,000, then you'll get the full 20% 199A deduction on your business income. If you're married filing joint and your income is above $415,000, then you'll probably basically will get no deduction at that point using 199A. Now the good news here is, guys, is virtually what this is saying that is if you have this deduction is really awesome. I mean, it really is, because let's say your taxable business income is $100,000. Well, if you get the 20% deduction, it reduces your taxable business income by $20,000. That's a huge advantage. You get a huge tax savings right there, because that's a lot of money that no longer has to go to the IRS. The good news is, if you think about it, is that most people's income is going to be below this. So most people who own a business, I would expect them to be able to get the full 20% 199A deduction. It's just for the very wealthy, the people who are very, very well off will not be able to get the full deduction, or it will be a limited deduction. All right, so let's talk about the W-2 and on-adjusted basis limitations. It's called the phase-in. So this is where it gets really complicated, but the limit is this, and this all deals with 199A. The limit is greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of on-adjusted basis. We don't know what they mean by on-adjusted basis. We're assuming they're just talking about the on-adjusted basis of the book value of the assets, but it's not been defined by the IRS yet, so we don't even know what they're going to rule on that. The phase-in occurs when taxable income exceeds $315,000 when married filing joint, which we just talked about right up here, or it exceeds $157,500 when you're filing single. So these are just some of the key facts, guys. And a couple things to note, there's a lot of limitations on service-oriented businesses. So I put a note in about that. It says, note, special limitations may apply for specified service businesses, which includes any trade or business involving the performance of services. Examples include healthcare, law, accounting, consulting, financial services. It also includes investing in investment management or trading. So that those businesses aren't getting this, they might have further limitations applied, so they may or may not receive this deduction. Basically, the way I understand it is if their taxable income is below this, they're still going to get the deduction. But if their taxable income overall is above this, then they're going to struggle they might have a very limited deduction from 199A, or they might get no benefit from it at all. So it just depends. But they're really harping down and hammering down on service businesses. Okay, guys, a couple other things to mention real quick. Hobby loss rules. Income from a hobby is taxable, but expense deductions are no longer deductible. This, in my opinion, really kind of ticks me off. But so if a person has a hobby, if they make income, they're supposed to report that income. But now, if what they're doing is a hobby, they can't offset that income with expenses. I honestly wonder how many people are going to report that income in the first place, knowing that they can't even deduct anything against it. Now, for anybody who has a hobby or their business has been deemed as a hobby, do the best you can to make it a legitimate business so that all the deductions and all the expenses you incur to generate that income become tax deductible. That's my advice for you, is try to make it a legitimate business. Maybe meet an attorney, get an operating agreement, depending on the kind of business it is, form, like a corporation or partnership, whatever. But just try to run it like a real business so that you're not subject to these silly rules that expenses are no longer deductible. The minimum tax credit for corporations, refundable up to until 2022, refundable for any tax year beginning after 2017 and before 2022, in an amount equal to 50% 100% for tax years beginning in 2021 of the excess MTC for the tax year over the amount of the credit allowable for the year against regular tax liability. I know I lost you guys there, but go ahead and you can go back to the spreadsheet and reread that, and I think it will make more sense to you. Domestic production activity deductions have been repealed, but the good news is you get the $199.80 deduction, so it's not all is lost. Not all is lost. Now, guys, I went over this pretty fast. I intended to. I really wanted to get straight to the point and make this video as short and concise as possible. All the links I used to pull this information and form this whole spreadsheet are down here, and you'll find it by subject, as I've color-coded it with the color coding above for each subject. You can find more information about all these different topics and all these different articles just by clicking these links, and it'll take you right to it. Okay, guys, I hope you enjoyed the video. I hope you got something out of that. I spent a lot of time. It took me several nights during the week to make this spreadsheet. It took me hours to make this spreadsheet because I couldn't find anywhere on the entire internet where it summarizes this information anywhere like this. So this is my treat to you guys. You guys have requested it. Thank you for that request. I think it's a great topic and a fun thing to talk about. All right, guys, to sum this all up, I think if you're a business owner, I think these new tax laws are probably going to be pretty favorable to most business owners. But let me know what you guys think. I think there's a lot of new changes with these new tax reforms. This is actually, I don't know if you guys know this, but this is the largest tax reform we've had in this country since 1986. So it's a tremendous amount of changes. But we'll just see how the regulations roll out and see what the IRS provides as guidance, especially on the $199.80 deduction. There's a lot yet to come on that, so we'll just wait and see. And if you guys have any requests on any of these topics, let me know and I can make a video about it. But each topic I could probably make a 10 to 20 minute video on each one of these topics because they're so broad and so detailed with all the new changes involved. But this was just a simple overview, so I hope you guys got something out of it. Remember, if you liked the video, guys, to hit that like button to let me know you liked it. Be sure to share this information with a friend, especially if you know somebody who's a business owner. Honestly, feel free to share this spreadsheet with whomever you think it would help. I'm going to leave a link to this video actually within the spreadsheet, near the bottom of the spreadsheet, so that anybody who wants to can go back and review this information at any time. And I just would love to hear from you guys, so please drop a comment down below before you leave. And with that being said, thank you so much. It's such an honor to be able to produce videos for you guys and interact with you guys over YouTube. So I will look forward to reading your comments and questions and all that good stuff. I hope wherever you're at, you're having a wonderful week. And with that being said, I hope you use this information to live your life uncaged. I will see you guys in the next video. Be sure to subscribe if you haven't already. All right, bye guys. Peace.